All right, what is up, tycoons? What's up, traders? Super excited for today's video. Going to give you guys a TLT and market update. As always, we're going to go over a few charts and take a look at some of the data driving the prices behind TLT as well as the stock market. Okay, so make sure to smash the like button, subscribe to the channel if you guys are new. And if you haven't been watching the videos, then you may be surprised by this current move that we're seeing in the stock market as well as the bond market. But if you've been following the channel, we've kind of been expecting this move. So the first chart we're going to look at here is TLT versus the S&P 500 futures. TLT is going to be here, or I'm sorry, TLT is rather going to be in red, and then the S&P 500 futures is going to be here in blue. And anytime there's been divergences, TLT has been the leading indicator, which nobody else on YouTube is really making this chart and showing this to you guys. And this is something that's been in effect for the past year, and this pattern doesn't have to repeat itself, but if it continues to repeat itself, it's going to be a really useful indicator. Okay, and so what I mean by this is anytime that the S&P 500 futures have been going up, right? So in this case, we're in an uptrend creating higher highs. Meanwhile, TLT was creating lower highs. TLT has been a leading indicator, and you can see that the S&P 500 shortly after followed. Same thing happens over here as well, right? We see TLT going down, making lower highs, while the S&P 500 futures are creating higher highs, and it ends up following what TLT is doing. Now, it also does it to the upside. So in this case right here, we have the S&P 500 making lower lows while TLT is making higher lows. And what do we see? The S&P 500 follow. And this has happened multiple times throughout the past year and been a really, really good leading indicator. And we can see that, the S&P 500 futures, the stock market was really rallying, but meanwhile, TLT was actually creating lower highs. And we were saying that if this pattern is going to play out, we were expecting a large downside move in the stock market, and that ended up happening, right? And TLT has also continued to drop as well. If we take a look at our next chart, a lot of people may not be prepared for this, right? Now, this isn't a guarantee. There's no, 100% way of tracking the stock market and predicting future movements. But one of the really good tools out there is using the Wyckoff method, right? And so that's what we're going to be taking a look at over here. And we have SPX right here to the left. Okay, this is the S&P 500 index. And you can see it's matching up and aligning with the Wyckoff method very, very well, right? We have our spring over here. We have spring as well. And then you go through the distribution phase, right? And you can see that over here as well. Then you get the breakdown and throwback, right? Breakdown and throwback. All right, we got that. And then we come down here and we're in our correction phase, right? So notice how we made a high and then a higher high. We made a high and then a higher high right here. And since I've really made this chart and been tracking this chart, I've been highlighting that, hey, we could be due for a very massive move to the downside if this Wyckoff method over here is going to play out. Now, so far, we are, tracking and correlating very, very well with it, right? We got all the previous phases, right, from spring to throwback. We're in that correction phase, and we came out here and we started to get a large pullback. There's no guarantees that this is going to play out, but it's definitely a scenario you need to keep in the back of your mind, because if we do end up getting this correction phase to play out and heading into redistribution over here, that's going to coincide with a very, very sharp downwards move and potentially could take the S&P 500 from anywhere to 2,800 to 3,400. So, I'm definitely bullish on the markets, okay? But I'm also trying to remain unbiased, okay? Because if you're too biased to one side, you're not going to be able to keep an open mind to some of the possible scenarios. So while I am a bullish in the stock market long term, I have to keep in mind some of these possible bearish scenarios. Now, just besides the structures that we're going through and the technical analysis, a lot of the economic data has been supporting some of these moves. So first off, we're going to go ahead and take a look at TLT, give a nice breakdown of it. And what we're looking at here is going to be our 5-wave structure that we're targeting. Okay, so that's going to be in orange. We have our wave 1, 2, 3, 4, and 5. Now, wave 1, 3, and 5 should be 5-wave impulsive moves. And that's been tracking pretty much throughout the whole year up until recently. We got 1, 2, 3, 4, 5 down. Okay, and your wave 2 and your wave 4, those are going to be ABC correction waves. That's how they let you know it's a corrective wave versus an impulsive wave. So you should see an ABC structure, right? And that's what we did. We got our 1, 2, 3, 4, 5 down, then we got an ABC up, okay? And then we started our next leg down with a 1, 2, 3, 4, 5. That gave us our wave 3 targets, okay? And these are the wave 3 targets right here. We have our wave 5 targets right here on TLT, which is going to take us down to 87, possibly even to $80.93 after getting our ABC wave up. Now, we did have this trend line here that we were respecting for a very long time, that white dotted trend line. As you can see, we got a breakout retest, and then we pushed up higher. But what we did was we actually formed a double top here, and we could be potentially looking at an M pattern that'll take us down to this gap around $95 on TLT. The structure was very clean on our ABC up. Then we got our 1, 2, our 1 down and our 2 wave up. We were able to close some short positions here. Okay, and a lot of people rode this wave up, and it was very tricky. For over 2 weeks, TLT was moving sideways and really put in this bull flag structure right here. So I wasn't very sure if we were going to continue following this structure or if we were going to get a breakout to the upside on TLT and possibly invalidate this entire structure that we've really been tracking. Now, on top of just this structure that we're looking at, we also use the major Fibonacci retracement levels, okay? And those three specifically are going to be the 61.8, 50%, and 38.2% levels. The reason you use these is nothing moves in a straight line down or in a straight line up. Rather, you get a move down retracement, continuation of the trend, or a move up retracement, continuation of the trend. And we can see that we've gotten a move down retracement, continuation of the trend, right? Retracement, continuation of the trend, retracement, right? And then we try to continue that trend, but we actually bounced there, okay? And we rejected our major levels again. These 3 levels that I just showed you guys, these are the 3 most common and well-respected Fibonacci retracement levels. So, we're doing a really good job of still respecting those levels. And here's how we could spot a potential reversal, okay? If you move down, retrace, consolidate like we did over here, okay, and then break through those levels, that's how you could spot a potential upside reversal. But rather than getting that upside reversal, we ended up putting in a double top. We broke that bull flag structure right here, and we started to head lower, and we filled this gap that I said we were due to fill here sometime soon below this 102.88 level. Now we've started consolidating a little bit, and to me, this is forming a little bit of a bear flag structure, right? So if we draw our line here, and then we have a little bit of a flag like this. Now, it's not guaranteed, okay? We could be due for a little bit of bounce in TLT and, could see some upwards pressure. But if we flip this 102.88 level to resistance from support, as you can see, we've broken down and now we've tried to retest it as resistance and try to break through. If we can flip that to resistance, most likely we're going to get this next leg down, heading us into that $95 to about $96 territory on TLT. And right around somewhere in that range, we're going to be expecting some type of a bounce. Keep in mind that this structure is here before the actual, candlesticks appear. So it's just meant to be a rough guideline. We're not meant to exactly bounce right here at this level. It's more of just an overall structure guideline that we're going to be looking and tracking to see how things play out. Now, you can also use the MACD as well as the RSI to help give you an idea of possible future price action. So in specific, if we take a look at the RSI here, we had a bearish divergence, right? So notice how we had a high and a lower high here. Meanwhile, we had the high and the basically equal high here, right? We put in that double top, but meanwhile, rather than keeping the same amount of relative strength, we had a high and then a lower high on the relative strength index. So when you're creating a high and a lower high, but you're, essentially creating equal highs up here, that's going to be a slight bearish divergence. Now, what we also did was we put in a little bit of a rising wedge while we had a bearish channel forming on the relative strength index. So if you take a look here, okay, you can see we have a little bit of a rising wedge in this area right here, okay? And meanwhile, we actually had a bearish channel forming on our relative strength index, right? We take a look, and these are where the 2 points coincide together. We're making a low and then higher lows here, but we're actually making a low and then a lower low. And here we're making a high and then a higher high, but here we're making a high and a lower high. So we had a little bit of a slight bearish divergence that was a little bit longer, and on a shorter term trend, we actually got a bearish channel right here, another bearish divergence while we had this rising wedge, and we got the breakdown from that rising wedge, and it took us to our gap fill. So we may see a little bit of a bounce before heading down to that 95 to 96 area. But above 102.88, we could potentially be trying to reclaim some of our previous areas. So definitely keep that in mind, right? 102.88 is going to be a very big psychological level. It's going to be a really big, important level for determining, if bears can continue pushing this thing lower, or if bulls have the potential to push price up higher and really invalidate the structure that we've been tracking. If we zoom in a little bit, okay, we'll go and discuss the MACD signals. So you can use these for different entries and exit signals. You want to pay attention to the red line here. So here we get a cross above, right? And we get a cross above right around this area. And you see that we get a nice move to the upside afterwards, right? And that gave us our ABC correction wave that we were looking for on the wave 4 targets. Okay. Next thing, what do we end up getting? We end up getting a MACD crossover to the downside right in this area. And you can see shortly afterwards, we get a very strong move to the downside for a wave 1 down of the following 5-wave structure. Over here, after we get our wave 1 target down, we start bouncing off of this trend line. And what do? We end up getting an entry signal. The red line curls above the blue line here, and we get another move up, ultimately before rejecting our 61.8% retracement level again. And as we consolidated through here, the main point that I made to a lot of people was don't force a trade. Too many traders force a trade and feel like they have to be making a trade every day or every single week. And rather, you want to wait for the signal. So while things were unclear and consolidating for over 2 weeks, we were looking to see what the MACD was going to do, to see if it gave us a possible, exit or entry signal. And you can see we ended up curling down right here and getting that exit signal and ultimately moving very low below that afterwards, right? Combine that exit signal with also the bearish divergences that we went over on the RSI, and things became a lot more clear after waiting for the structure and waiting for the candlesticks to play out, rather than just forcing a trade just because we were going up and below our 50% level at 106.29. Now, we're going to discuss some of the things that are pretty important right now. Now, the Fed's been talking a lot about real estate prices, and they're saying in both residential and commercial property markets remained high, and that the potential for large declines in property prices remained greater than usual. So that's definitely something to, be cautious of if you're trying to get into real estate, is that the Fed is essentially saying that they see and they think that large declines in property prices essentially remain greater than usual. Now, something that a lot of people are looking for is the Fed pivots, and everyone is trying to buy in before the Fed pivots because they think that that is going to be the bottom. But if you take a look here, when the Fed pivots, stocks crash more. And the reason being is because they're pivoting from, a tightening financial status to a easing and loosening financial status, because the market is actually in shambles, right? And so if the economy is looking really rough, that's going to translate to stock market valuations, okay? Company valuations and earnings projections, they're not going to be as good if the market looks like total crap. And so that's when the Fed actually pivots, is a lot of time when things are a complete disaster. So if you take a look, the Fed pivot in 2007, the S&P actually bottomed in 2009. If you look at the dot-com bubble, all right, the Fed pivot was in 2000 of December, and then the S&P bottomed in September of 2000. Over here, 1989, Fed pivot. October 1990 was the bottom. June 1981 was the Fed pivot. July 1982 was the stock market bottom. October 1973, the Fed pivoted, and then the S&P bottom is in September 1974. Right here, March 1970, the Fed pivoted, and then the S&P bottom was in June 1970. So on average, it takes about 14 months from the Fed pivot to actually see a stock market bottom. Now, if you're watching this video, a large part of that is due to the fact that you're into TLT, okay, and you're into the bond market. One thing to keep in mind, which I don't have this graph on this presentation today, but I've shown this graph many times, and I try to include new data in my videos, is that the bond market bottoms before the stock market. Okay, there's 6 phases to the market cycles, and the bond market is going to bottom before the stock market. So there is a chance that perhaps once the Fed pivot occurs and rate hikes start declining and going down, that is when you could see things like TLT going up. Okay, and the reason being is that bonds and the bond market are directly correlated and affected by what the Fed is doing with the interest rates, right? As yields go up on things like the 10-year treasury, right? TNX, you're going to see the prices of bonds go down. So TLT has been dropping as a result of the Fed fund rate and interest rate and treasury yields rising, right? So once those things stop rising and start declining, there is the likelihood that bond prices will eventually go up. So keep that in mind, right? In this example here, you can see that, the stock market bottoms after all of these Fed pivots. Now, I haven't gone back and checked out the data to see how the bond market and TLT have specifically performed since each Fed pivot, but just keep in mind the fact that the bond market is going to bottom before the stock market, typically in the 6-phase cycle of the markets. And it seems pretty clear to me that we're definitely in about phase 6 right now, and we're just waiting on when phase 1 is going to start, which is going to be the bond market bottoming. Okay, now if you take a look, the majority of the decline in these bear markets occurred after the Fed's pivot. So here, a negative 51% drop after the Fed pivot. Over here, negative 58% drop after the Fed pivot. Over here, negative 35%, negative 27%, negative 48, negative 36. Okay, and meanwhile, this is the Fed funds effective federal rate. So you can see, once they actually start cutting, that the market actually drops, right? And over here, they start cutting, and then the market drops. Over here, they start cutting, market drops, start cutting rates, drop, and that continues to happen each time. So definitely keep that in mind. The next one we're going to look at is the personal savings rate. Now we're at lows. We're testing lows that we really haven't seen in 2000 and since 2005 when it comes to the personal savings rate. So that just shows that, a lot of people are really in trouble and really just aren't able to save as much as they used to be able to save. Now, on this next chart, what we have is going to be the inflation expectations, okay? So if you take a look, inflation expectations have been on a downtrend, and we recently just broke that trend line and have started exploding to the upside. Okay, so you can clearly see the breakout here. What we have over here is actually the same chart, but just zoomed in a little bit, showing the October 2022 levels right here, which is about 2.85. And if you take a look at this chart again, you can see we're well above those October levels. So really, people are pricing in a lot higher inflation. And you have to remember the stock market bottomed in right around October, okay? Maybe not precisely, but I'm pretty sure that, we had the October bottom in the stock market, and inflation expectations are actually higher currently than what they are or what they were even in October, right? So we saw that bottom in October, and then we see inflation expectations drop and continue to decline, but we actually see that we got a breakout from that trend, and that does lead me to the potential to believe that we could potentially even retest some of our previous lows in the stock market, or even drop below them based on the Wyckoff chart, based on the TLT to S&P 500 futures chart that I showed you guys in the very beginning. Now, if what we have here is going to be the Fed fund futures rate. Okay, this is the Fed fund futures, and we can see, right, what we're actually looking at here is when they're pricing in a rate cut. So they're actually pricing in a rate cut here in February, or I'm sorry, this is February 2023. But if you take a look, right, this is actually February of 2024 when they're actually pricing in a rate cut. Okay, they're expecting it to continue going higher. Okay, and if you take a look at the basis points here, this is 5.4. So people are pricing in 5.4 federal funds rate to be hit sometime this summer through essentially October of 2023. And from 40 to 20, okay, is not even necessarily a full rate cut. Okay, it's typically going to be about 25 basis points. So for us to actually get below that 25 basis points level, okay, which will take us right here around 5.13, 5.15 really is where a 25 basis point rate cut would take. That they're not pricing that in now until February of 2024. So a lot of people have been telling you and are on social media talking about, and even the news, like mainstream news, CNN, CNBC, things like that, saying that, hey, the Fed is going to cut rates this year, and a lot of the market has been pricing that in. But when you actually take a look at the Fed fund futures, they're not pricing in rate cuts anymore until February of 2024. So pretty much an entire year from now. So keep that in mind, right? There is a very high likelihood, and the Fed fund futures are really pricing in that rate hikes could stay higher for longer throughout 2023 rather than actually getting a rate cut in 2023. And a large part of this is due to several inflation indicators. Right, we've recently had PCE come in hot. If you take a look here, this is the ZILLOW rent index. All right, and what you can see is that throughout the time, this thing has been on a steady incline, right, and definitely going up. But take a look at what it's done. Yes, some people may call this a peak right here and act like this is some big drop and see this as deflationary. But look at what it's doing. It really just looks to me like it's flatlining, right, and like we're really just starting to actually just move a little bit sideways and level out. Okay, it just seems like it's leveling out. There's no indications really that we're actually putting in a downtrend. We're really just consolidating. And so one of the other charts that I've been showing a lot has been core sticky inflation, and really just highlighting the fact that this inflation is going to be a lot stickier than a lot of people have basically expected. And so if you take a look at this chart here, you can see we're really just flatlining when it comes to the rent index, and just kind of emphasizing that whole thought that, hey, maybe inflation's not actually going to go straight down. Maybe it is going to stay sticky and just remain elevated longer than what people think. And that's going to cause the Fed to keep rates higher than longer people think. The next one is going to be people eating out. Okay, so this is a pretty interesting index. But this is the open table United States seated dinners percentage. All right, and you can take a look here, and this could hurt us in the March report. If you look on February 14th, which is Valentine's Day, of course, there was a huge spike. Now, it definitely dropped right after Valentine's Day, but even then, it's kind of above the median right now. If you just draw a line vertically or horizontally sideways, we are above the median right now, and that could result in some potentially higher inflation reports in the next March month. Okay, because remember, they're going to be lagging indicators, and they're the March data is actually going to show, or the March report is actually going to show the February data. So this is another thing to keep in mind. On top of that ZILLOW chart that we just looked at, this is also the used vehicle index. And so the used vehicle index it has actually been inclining and rising very rapidly, right? And we're actually above levels that we were at in November of 2021, right? So this is the November 2021 levels. You can see that we're actually peaking up above those levels, and we're the highest really that we've been, maybe not throughout all of 2022, but the used vehicle index is actually rising rapidly, and this is another thing that really could add to inflation and really hurt us in the March reports that we get for February. So be prepared for the market. I'm not a total bear and saying everything has to go down, but it is good to track some of the data, come up with your own thoughts and theories on the potential market directions and where inflation is going, versus just blindly listening to the media as they're going to portray what it is that they want to portray by the people funding them, and whether that is market makers and institutions and billionaires out there trying to gain liquidity for their next short positions by causing some bullish news to come out, so that way they can essentially sell all of their positions and short everything and fund it with retail buy orders. Maybe that's a thing, or maybe they're just trying to scare everybody out of the market sometimes and gain some liquidity, so that way they can actually buy in and scare everybody to sell and provide liquidity for their buy orders. We're never really going to know what the market's going to do. Nobody has a crystal ball, but we can all stay on top of the data and come up with some good ideas for ourselves and think on our own. I really appreciate you watching the video. If you made it this far, smash that like button, subscribe to the channel, and I'm out.